Today's video, we're going to talk about business funding, specifically conventional products versus revenue-based products. So this is one of the most common questions that we get is what do I qualify for and what's really the difference? So the main differences are the qualifying. When we say conventional loan, we're talking about going to your local bank, getting a loan, taking your manila folder, marching down to your bank, all the paperwork, filling out a mountain of applications, and then waiting about 6 weeks just to hear back from them. Specifically, conventional lenders are going to require a 720 plus FICO score. Time in business, they're going to require 2 years minimum. Financials, they're going to require 2 years of profitable tax returns, an up-to-date accounts receivable report, and a profit and loss. If you have a business, let's say you're in business for 5 years, you have over a 720 score, you have all your financials, you're going to be looking at 6 to 8 weeks to go through that whole process and to get approved. It might take a little bit longer than that to actually get your funds in your account, but that's roughly the real picture of what you're looking at as far as the timeline goes. Okay, so now when we compare that to something revenue-based, it's exactly that. It's based on the business revenue primarily. The qualifications change quite a bit. So you can see credit drops down to 500. Time in business, we only require 6 months, not 2 years. So that opens the door for a lot of new businesses. So it doesn't matter if you're just at that 6 month mark, but if you have consistent revenue coming in well over 10,000 per month, then this is a great option for you. So the financials that you have to include are only your last 3 months of business bank statements. So you don't have to worry about an AR report, profit and loss, you don't have to have an accountant, don't have to worry about any of that. Only your last 3 months. And the timeline is same day. So this can be funded the same day because the underwriting is really looking at your industry, you, and mainly your business bank statements. That's what this whole approval is driven off of, is the current health of your business and how the revenue is performing. An approval for something revenue-based is going to be up to 100% of your monthly revenue. So if you're a local business doing $50,000 a month, let's say you've been in business for a year and you have the opportunity to buy inventory, buy some equipment, do advertising, bring on another crew, really anything that you can use to drive in more revenue, but you don't qualify for this, this is a great option for you. This is good. Now, let's talk about rates. Rates on a conventional loan are going to be much lower than they are a revenue-based product. The reason for that is you have to be a much more well-qualified borrower to get a conventional product. It's also secured by collateral. So you're gonna have to put up house, you're gonna have to put up some type of collateral to get approved for this product. So that's why it's less, because it's much more secure. Whereas when we're talking about something revenue-based, again, this is funded the same day off of your bank statements with very little underwriting. So you're gonna pay more for that money, you're gonna pay more for the speed of that money. Let's say, for example, you're a business that meets all these, right? You meet the time in business, you meet the credit score, you check all the boxes, but you have an opportunity where you need the money quicker. You don't have 6 to 8 weeks to wait on the money. You need it either today or next week, much sooner than that. Then that's where revenue-based financing comes into play. A lot of our clients will use this as just a bridge and use that money to make more. So like I said, they would buy inventory, they would turn that money around, flip it, and even after paying the interest on this, still turn a profit. So that's what this is used for. This type of funding isn't used for put it in the account for a rainy day, or I'll take the funding just in case. This is for you have a plan for it. This isn't about what you borrow, it's about how you deploy it. So those are the main differences, is credit score, time in business, and financials, and obviously timeline. So if your business could use additional capital right now to grow, to expand, to do some type of activity to bring in more revenue, then give us a call. We'd be happy to go over this with you and at least show you numbers to see what you qualify for.